Wall Street is getting ready for the easiest money they've seen in years, and it's coming faster than anyone expected. Right now, traders are quietly betting that interest rate cuts will happen much earlier than the Federal Reserve has planned. And they're not just talking about it, they're already positioning billions of dollars into stocks and ETFs that are quietly gaining momentum. Just last week, certain sectors saw major inflows and surprising gains, and that tells us something important. Wall Street may know something you don't yet. So in this video, I'm going to show you what signs Wall Street is reacting to, which stocks and ETFs are already heating up, and how you can position yourself now before the opportunity disappears. Oh, and we'll also cover one major political wildcard that could speed all of this up, and no one's really talking about it. Let's get into it. First off, the Fed says they plan to cut rates only twice in 2025, but Wall Street, they're pricing in 4 or more cuts, possibly starting much sooner. In simple terms, smart money believes borrowing will get cheaper, stock prices will rise, and yields will fall, so they're getting in early before the crowd catches on. We're already seeing movement in key ETFs, QQQ, tech and growth stocks, XLI, industrials, VTI, the full US stock market, TLT, long-term bonds. These aren't guesses, these are signals, and Wall Street is acting on them fast. What's pushing them to act now? Let's look at what the Fed is seeing, but not yet saying. The data is getting harder to ignore. Housing starts just fell to their lowest, reaching levels we haven't seen since 2020. We're also seeing clear signs of slowing job growth and dipping consumer spending, trends that are consistently supported by recent economic outlooks. These are the classic signs of an economy that's cooling down fast. And while the Fed isn't panicking publicly, they know what this means. More economic pain is coming. And rate cuts may be the only way to ease it. For lazy investors, this is the moment to start positioning into long-term bond ETFs like TLT, dividend ETFs like SCHD. These assets tend to benefit before official rate cuts happen, if you act early. But there's another twist in this story, and it's coming from Washington, not Wall Street. President Donald Trump has made it clear, since taking office in January of this year, he's considering replacing Fed Chair Jerome Powell before his current term ends in May 2026. Why does that matter? Because any replacement is likely to be more aggressive with rate cuts, prioritizing economic growth over inflation control. And Wall Street knows this. That's why we're already seeing investor interest rise in rate-sensitive sectors like real estate and utilities, and dividend-heavy ETFs that thrive in lower rate environments. So while most people are still watching the Fed's statements, Wall Street is watching the White House and positioning ahead of time. So what can you do right now to ride this wave without guessing or overthinking? You don't need to time the market perfectly, you just need to position like the pros. Here's a simple 3 ETF combo for this environment. VTI, broad US market exposure. TLT, plays the bond rally if rates fall. SCHD, solid dividends plus defensive positioning. Set it, forget it. Add consistently. That's how lazy investors ride Wall Street's wave without stress. Wall Street is already moving. The Fed might soon follow, and you still have time to position before the next big shift. Forget the noise, watch the flows, stay consistent, stay lazy, and let the strategy do the work. If this video helped you understand what Wall Street is seeing, hit that like button so YouTube shows it to more investors like you. And don't forget to subscribe. I break down what the Fed and Wall Street are doing every single week so you can invest smarter with less stress. If you want to understand why the Fed hasn't cut rates yet and how unemployment plays into their strategy, check out last week's video right here.